Welcome to Investors Insights. Our topic today is It's All Connected. We're excited to have you join us today. We've got a lot of topics to cover in relation to your portfolio and the markets. And also just know that in this conversation and debate and discussion that we have, we will continue to have it throughout the week with additional blogs as well as social media in terms of LinkedIn, Twitter, and Facebook. We hope you follow us on all of those outlets as well. So with that said, I'm joined by my distinguished colleagues who I've just finished a great meeting with, Trey Booth, Bobby Norman, and Adam Van Zant, all part of the Portfolio Strategies team here at Five Plan Partners. Trey, let's start off with you. You really helped us develop the title this morning, It's All Connected, in relation to all the things that are taking place, not just here in the United States, but across the globe, and how the supply chains and everything make a difference to a growing economy. Talk about that.
Yeah, definitely. Thanks, Greg. Yeah, so I feel like a broken record, and we prefaced this last week that the most important data point each month is the jobs data point. And that's because that's the information that the Federal Reserve is looking at to decide whether or not they should reduce, increase, continue their bond purchases, being very accommodative. The Fed has said that they're going to wait, that they're looking for the economy to get back to full employment. Well, we took a very big step forward on Friday with the July non-farm payrolls number. 943,000 jobs were added in the month of July. That's a huge step forward, very positive. We saw the opening trade come into play on Friday. We saw stocks that benefit from a strong U.S. economy benefit on Friday. We saw individual areas that benefit from a weak U.S. economy actually go down on Friday. So it's definitely connected to the stock market. It's connected to the bond market, and that if you have less Fed stimulus, you likely see higher interest rate. We saw a small spike in interest rates. We also saw, which is interesting, a stronger dollar. Usually higher inflation, higher economic growth means a weaker dollar. And so on Friday, we saw a strong dollar. And that's likely due to that this is not a one country economy and market. Looking at the U.S., everything is strong. But if you compare us to the world and how we're all connected, we actually got some bad data out in the global areas. We saw China imports, exports decrease. We saw U.S. car demand drop. And that's not because people don't want to buy cars. It's that we can't produce cars because the supply chains are impacted. We saw Vietnam and Thailand really fall off a cliff in their production, largely due to increased variants, potentially from COVID. We're seeing wages go up in the U.S. We're seeing across the world things kind of slow down. We saw West Texas Intermediate crude prices drop to $68 a barrel at a time that the summer driving season in the U.S. has never been hotter. And so it's all very connected, the U.S. economy to U.S. interest rates, to U.S. dollar. And so we got some really good data on Friday, but there's still some cautious, maybe some yellow flashing lights globally.
Yeah, there's no doubt about that. And I thought you brought up great points there that also emphasize putting together all the pieces of the puzzle. These are all the things we need to track on a regular basis here at Five Plan Partners as we navigate our clients through the volatility of the markets and also keep them in line with their financial blueprints. So I just thought you did an excellent job tying all that together. And Bobby, you jumped in on the interest rates discussion and debate. Because everybody's going, look, I mean, how much lower can these interest rates go? Are we going to see inflation? What's taking place here? So elaborate on that.
One of the most frequent questions we've been getting from clients lately is what is going on with rates and where is the best place to get any yield without taking too much risk? And so with yields ending last week at 1.3%, I want to talk about a few reasons why rates are staying lower when there are actually reasons for rates to be higher. So higher inflation, recovering economy. So here are a few reasons why rates are remaining low. First, the Federal Reserve is still purchasing $80 billion a month in treasuries. More inflows are keeping rates lower. Second, there remains $16.6 trillion in negative yielding sovereign debt globally. Again, keeping U.S. rates lower. Third, the federal budget is poised to decline. That's going to limit new supply of bonds. Number four, persistent strength in stocks are leading to portfolio rebalancing. More money flowing into bond funds. Again, more inflows keeping rates lower. And the final reason that we're seeing is investors are actually hedging against possible geopolitical risk or a policy error like raising taxes. So more money into treasuries for safety. And so while lower rates are great for individuals looking for mortgages or refinancing their home right now, it has been tough for income investors. It's causing us to have to be more strategic with our income producing investments. And so we could see rates go higher as the Fed starts to taper possibly at the end of this year, but yields matter because it impacts investment strategy and it impacts certain sectors more than others. So something we're watching carefully.
People forget about this, but there are a lot of negative interest rates around the world. That has had a huge impact on this, as well as some of the other items that you just listed. I thought it was a great checklist, and I would encourage everybody, if you rewatch this vlog, to make that list, because we're watching that on a daily basis to see how those variables can change, just like the information that Trey brought us. And then Adam, on the technical analysis, the market has still shown a lot of strength. It ties into what Bobby and Trey were talking about. Last week, Trey and I did a blog talking about don't fight the Fed. The trend is your friend. This just continues to be a theme here. So talk about the technical analysis and the resistance and support levels in the strong market.
Yeah, thanks, Greg. And to your point, we saw one of the steadier weeks last week in terms of markets. So Friday's S&P 500 close came in at 4,429. That gives us a new resistance level of 4,460 with a new support level of 4,400. Trey talked about it a little bit with some economic strength we're seeing, at least from a domestic standpoint. And there's evidence in that with a 100-day moving average currently sitting above 4,200, which is 4,206 to be exact. So like Trey said, we're starting to see some of these fundamentals correlate with some of the technicals. And that's going to be important looking forward from an international standpoint to see what these markets are going to do.
This has been a very strong summer for the markets. I've seen a lot of strength. I think it's historic times, not only because of COVID and how the economy has had to come back, but also what's taking place in the way we as individuals and as companies are doing business. Just like this morning here, we are doing a Zoom, to our clients. It's great to be able to have that advanced technology to do that. So a lot of things that are coming out of this economy in ways that we've never thought about before. We hope you have a great week. We cannot believe we're in the month of August and that 2021 continues to move forward. We're excited about all the data and information that we're seeing, and we will continue to watch it and piece together for you all these details and how it applies to your portfolio, your financial blueprint. And in wanting to keep you on track, we want each and every one of our clients to have a better, richer, fuller life. Take care. Have a great week. Talk soon.